Hi, everyone. I am Angela Giroux, publisher of the Bauman Letter and your host for Your Money Matters, where our experts Ted Bauman and Clint dissect the markets and give you some great opportunities. Now, in Ted's video on Friday, he did mention that we will be releasing a new Bauman Letter recommendation today. Actually, two. We got a bonus one this month. And these are really unique opportunities to boost your income, not stocks, not ETFs, not bonds, but something you're going to want to know about. So make sure you click the link above or below for more details and to join, of course, risk-free. And again, I can't stress this enough like I always do. It is a fantastic time to get in on these sort of opportunities, considering everything that's going on in the world. What's going on in the world? Delta, of course, it's the word on everyone's mind. So I'm actually going to pull up a chart so we can see just how much havoc this Delta is wreaking on the economy. And as you can see in this chart, it's not just here in the US, it's across the globe. In fact, in the US, we're a little bit better off, and it's still not a rosy picture. You can see that Delta is causing estimates of US and global economic growth to fall, and quite significantly at that. And then along with that, I've got another chart. Of course, consumer confidence is absolutely collapsing. Look at what's happened in this last month. I mean, that is ugly. It's a decade low. And then, of course, we have Washington. That doesn't help anything. Do they ever? The Democrats are really struggling to get through their infrastructure bill, their social spending bill. And today is Friday as we're recording this, and we can see this pullback in recovery stocks as a result of all of this. Treasury yields also fell. So Ted, this is all very bad news, and I'm sick of thinking about it and looking at it. So what I'd like to do today is look ahead, because someday, believe it or not, this is all going to be behind us. And I'd like to know what's waiting for us on the other side.
Well, that's a fair question. I think everybody wants to know what's waiting on the other side. Where's the light at the end of the tunnel? You mentioned that recovery stocks are falling. There's a little bit of an uptick today in growth stocks, which paradoxically have become the defensive stocks of the roaring 2020s. The problem is that they're already overvalued, so they really can't go much higher than they are. So that means you're kind of stuck between a rock and a hard place, and that's why we want to talk about where you can position yourself now to reap gains that are going to come from fundamental secular trends in the economy. And the one we want to talk about today is productivity growth. The pandemic has led to a lot of investment in automation. I mean, you see it in grocery stores, you see it in restaurants, you're seeing it behind the scenes in places we probably don't even know about. Somebody posted a picture the other day of a robotic cleaner at an airport in Ohio. I think it was Ohio. That's the kind of stuff that's going to start happening a lot. And what that's done is it allowed profit margins to reach all-time highs. I mean, a lot of people don't know, but corporate profit margins in the United States reach all-time highs this year in the middle of a pandemic. So there are predictions that productivity growth could double to 4% per year in the middle of this decade. Now, this is not just about profits, right? It's also about the fact that we're losing workers. We have an aging society. We have falling birth rates. We don't want to let workers into the economy via immigration. So now labor force growth is less than 1% per annum. That's not enough to keep up with GDP. I mean, basically, all GDP growth is the combination of labor force growth and productivity growth. It's a mathematical definition. So with labor force growth so low, it's putting pressure on employment. And we had 3.5% unemployment rate below or before the pandemic. That's the lowest ever been. So it's labor. Now, if businesses want to keep up, they're going to have to pay workers more. But unless they're going to accept lower profits, they're going to have to increase the output per worker. And that means more machines to substitute for labor. Now, theoretically, that allows wages to rise faster than prices. That's what happened after World War II. That's why it was like a golden age, because we were getting rapid productivity growth. Workers were able to earn more. Their real incomes rose because their wages rose higher than inflation. And it was all because of productivity. So basically, if we have increasing productivity, we can raise wages. That's good for workers. Prices will fall. That's good for consumers. and corporate margins can increase, that's good for companies and for shareholders. And the critical thing is, I think, that the US corporate sector has recognized this, and after a long drought of not investing in physical capital, they're starting to do it. It's up dramatically this year. Now, I want to give an example. I don't want to be too scholastic here, but this is from the economic history. This is US, it's a chart that shows total farm output in the United States and the number of farm workers from about 1950 up until roughly the 2000s, 2010s. Now, what you can see is that the rate of increase of output was great. I mean, we almost tripled the total farm output in dollar terms, but the number of workers, fell from 10 million to, about 2.5 million over that same period. So what that means is that you were getting a lot more out of farming than you were before. And that was because we replaced donkeys and mules with tractors, right? I mean, so all kinds of things happening. Now, here's an interesting chart that shows, what that means for farmers and for anybody involved in farming. And that meant that the total dollar of output that you got per dollar that you spent on these labor-saving devices actually rose significantly up until around 2006, mid-2000s. And what that means is it's a winning proposition to spend money on automation and on machinery and that kind of stuff. And that's where we are right now. Speaking of where we are right now, here is the current state of automation in the United States. This shows the number of robots per 10,000 employees. Now, in all industries, it's really, really low. It's lower than Japan. It's lower than China, I think. It's lower than South Korea, certainly. Those companies or countries that are really focused on manufacturing are going big into this kind of stuff. Our manufacturing rate is only 200. In the auto industry, it's much higher. Amazon is one of the leaders in the US economy in robotics and automation because they know that that's how you make money. And Jeff Bezos is probably the most ruthless capitalist in the United States today. He'll say he cares about workers, but really what he wants is money. And he knows that's where he's getting it. And that's one of the reasons why Amazon is so successful. Next chart shows that the prices of robotics have dropped significantly while the price of labor keeps going up, not a lot. But it says it's a winning proposition. Now, the last one I want to show you is the relationship between operating margins, which is the money that you get above and beyond what you spend to make and produce things, versus the share of labor. And as you can see, the further to the right you go, the less money that goes to labor as as a share of the money earned by a company, the more goes to operating margins, which means it can go back into investment or into profits. So again, this means that automation is good for shareholders and good for that part of the economy. Only downside is this is what happened. Next chart shows what happened during the farm revolution. The share of farming income that went to labor collapsed. It absolutely collapsed. And it wasn't just because of the number of workers. It's because automation allowed those operating margins on farms to rise, and it meant that the farmers who are employing workers were keeping more of that as a return to their investment in automation. This is where we're going to be looking at over the next decade or so, I think. It's going to be one of the big drivers. Any company that is taking this seriously and is moving into automation and labor saving is going to be doing them and their shareholders a favor. The big question is, what's that going to do to the overall employment situation in the economy? And is it a stable political outcome? We'll leave that for another day.
I'm more interested right now in how to play it. So Clint, I am going to ask you, it seems like stocks are just so expensive right now, but it does seem like this productivity, this automation is inevitable. So what is the best way to play it?
You're right. I mean, stocks are expensive. I mean, all the return of the S&P 500 this year has been driven entirely by earnings growth because you had the forward multiple on the S&P on the PE ratio still sitting at 22 times. And that's just at the high end of what we've tended to experience historically. So if you want to, you're not going to get more upside because investors are willing to pay more for earnings. You're going to get the upside because you're going to have to grow earnings. And there's two simple ways to grow earnings. You grow your top line and that flows through to the bottom line. Or if you don't have great growth prospects ahead of you, you got to find a way to cut costs, increase your margins and increase earnings that way. And that's where, coming back to this theme today of talking about productivity, that's where you can look at robotics and automation from both of those angles, companies that are supplying robotics and automation to grow their top lines, or what companies are best positioned to take those advances and use that to reduce costs, increase margins, and ultimately increase earnings per share. So, when we talk about robotics and automation, I mean, the first image that always comes to my mind is the auto factory floor, the robotic arms that are spinning all over the place, welding pieces together. It is expanding way beyond that. The software component, when you start talking about robotics and automation, you have to start thinking about the software component to this as well, because just the advances that we've had in artificial intelligence, machine learning, that's opening up a lot more applications. And I have just one example to show of this. So this is a chart that shows something called robotic process automation. But all this is just software just performing repetitive tasks that people would usually do, like things like data verification. This market barely existed several years ago, and you can see through 2023, this is a $10 billion in global sales. And this is just one area. This isn't the entire market for software. This is just one area where you're seeing software for automation grow. So when you look to leverage this theme, the one thing I would look for is what ETFs or companies that are combining the two. And so the first one I would bring up is with BOTZ, ticker BOTZ. This is a Global X robotics and artificial intelligence ETF. So it's combining those two areas. And just as evidence of that, when you look at the underlying ETF's exposure, about 41% of its assets are in industrials, another 40% in tech sector. So that's a sector allocation that shows you that it's balancing its exposure across those two areas. For people also that are concerned about the state of U.S. valuations and you want to go international, 57% of the fund is in international securities as well. And I think now is a good time to look at picking up shares. So here's a chart of BOTZ going back about a year. And after the run up that we had, the ETF has just been consolidating sideways. One good sign is that you had price test the 200-day several times. That's the green line on here. That's what I'm highlighting with the arrows on the chart. But we're now just starting to take out sort of this trend line resistance on here that I drew on here. This dashed line. We are crossing above that line. At the same time, you're seeing the MACD and the RSI in the bottom panels becoming more constructive, showing you that momentum's picking up. So this is one ETF that I think is on the verge of breaking out to new highs with these tailwinds in place that we've talked about and the focus on productivity, and especially the supply chain disruptions that we've seen this year, just putting another spotlight on this area. Now, there's one more opportunity as it relates to this. Looking at maybe a sector that can take these advances and use it to reduce costs. And the one area I would look at is in transportation. I would look at transports, at logistics. Here's a chart really quick just to show sort of the expected growth in this segment of the market. This is the logistics automation market. And you can see for just the past couple years, it's been just slowly growing just a little bit each year. But then you start to get out into the next 3 to 5 years, and growth just absolutely takes off. So that's just the advances in technology that's coming along that these companies can tap into. And it's things like robotics in the warehouse, helping make warehouse operations more efficient. But another big area here is once again on the software side, using software to assist in scheduling, or for a package delivery company, optimizing your delivery route to save on time and fuel. And so one ETF you can grab for that area for transports is with IYT. And so here's a chart of transports. This is going to include companies in the airline sector, trucking, delivery companies, everything that we just kind of touched on. And this is potentially a nice area to step in and buy. Transports, had the big surge in price going into May as we had the economic recovery. But as some of you talked about the Delta clouds, as those have gathered, we've seen price pull back here. But the one thing I would watch with IYT right here on an entry is if we can get a close above this black line on here. We've seen the price pick up. This black line is the 50-day moving average. So a close above the 50-day signals a renewed uptrend, and that could be a good area to add exposure to transport companies here.
I'd like to actually throw in a couple other ideas, and I don't have ETFs for them, but I just want to point out that we actually have holdings in the Bauman Letter that are oriented to this. In order for all this to happen, you also need to have high-speed data transmission. And so we hold, for example, a company that specializes in providing what's called edge computing, which is essentially, it brings the computational power closer to the robotics or whatever it is, so that the latency between the software's instruction and the robot receiving the instruction is minimized, so you can get much finer grained automation. So that's an additional part. I think anything to do with commercial industrial applications of 5G wireless technology, both on the software and the hardware side, sensors, things like that, that's also going to be an important part. And we do hold those in the Bauman Letter.
I was thinking the exact same thing, Ted. It's the perfect recommendation, a pure play on this, and a couple other ones that really fit into this mold as well. So for those of you watching, again, it's the perfect time to join us, get more details. It's completely risk-free. So we hope to see you on the other side. And Ted and Clint, I'll see you next week.
Thank you.
Thank you.